Nobody who says Bitcoin is going to zero actually believes Bitcoin is going to zero. Not the guy in your comment section with the skull emoji, not the Nobel Prize winners who have been writing its obituary since it cost 11 cents, not even Peter Schiff, who has publicly declared Bitcoin dead 22 separate times and still somehow will not say that word out loud. My name is Nick. Right now, there's a woman named Lindsay sitting in a Sacramento parking lot before her shift, 43% underwater, who has stopped telling her sister the number. There's a man named Dale in western Kentucky running 8 mining rigs out of a converted horse trailer, doing math on a power bill. Neither of them is going to get an honest answer today. Because zero is the comfortable question. Zero has a comforting answer. And the bulls, the bears, and every single person selling you something in between would very much prefer you keep asking it. So let me tell you where we actually are. Because the emotional temperature of this conversation is running way ahead of the data. Bitcoin peaked at about $126,000 in October of 2025. As I am recording this, it is sitting in the mid-60,000s. Call it a 48% drawdown. Half your money gone in 9 months. And here is the first thing nobody tells you. That is not the interesting part. The interesting part is how it happened. Bitcoin did not crash. Bitcoin has crashed before, and everybody knows what that looks like. In 2011, it fell 93%. In 2021 and 22, it went from 67,600 down to 15,700, which is a 77% haircut and frankly an impressive one. Every previous Bitcoin bear market took somewhere between 77 and 93% off the top. Take a look at that chart for a second, because the shape of this one is different. Those were crashes. Violent, fast, over. This time the price just walked down a staircase, step, pause, for 9 straight months. And that matters because a crash produces panic, and panic produces a bottom. A staircase produces something else entirely. It produces exhaustion. It produces a specific 2 a.m. feeling where you stop being scared and start being embarrassed. Fidelity, which sells crypto products and therefore has every incentive here to be cheerful, put it plainly earlier this year. Every previous bear market took at least 77%. This one, at its June low, took about 53%, which the bulls read as proof that the market has matured, and the bears read as proof that we are not finished. Both of those are guesses. Neither one answers Lindsay's question. Before we get to the answer, one thing. Because a lot of you watching own exactly 0 Bitcoin and are quietly wondering why this is your problem. It is your problem because you are going to be forced to have an opinion whether you want one or not. Your brother-in-law has one. Your retirement plan is quietly adding a crypto option. Your feed has already decided you need one. And there is a guy named Hollis I want you to keep in the back of your mind for the next 15 minutes. In 2014, Hollis put $500 into Bitcoin because a coworker would not stop talking about it at lunch. Not because he understood it. Because the alternative was being the only person at the table who did not have any. That is the single most common Bitcoin origin story in America, and it has nothing whatsoever to do with monetary theory. More importantly, the skill underneath this question transfers. How do you put a value on something that produces no cash? That is not a crypto question. That is the gold question, the raw land question, the collectibles question, and the question sitting behind every private company anybody has ever pitched you at a barbecue. Get this one right and you own a tool. Get it wrong and you own a hobby that costs money. So let us actually answer it. Not the vibes version. The mechanical version. What would it physically take for Bitcoin to go to 0? There are 4 pathways, and I want to walk all 4, including the one where I hand the bulls a clean win, because a bear case that refuses to concede anything is not analysis. It is a personality. Pathway 1 is the one everybody imagines. The network breaks. Somebody attacks it, the miners walk away, the whole thing collapses under its own weight. No, not close. As of the middle of this year, the network is running at or near record computing power. Buying enough hardware to take it over would run you north of $10 billion, and running the attack costs over $1.5 million an hour in electricity alone. And here is the genuinely strange part, and it is on your screen right now. The computing power kept climbing while the price fell. Miners added capacity into a falling market. The network is fine. The network is aggressively fine. The network is honestly doing better than most of the people who own it. So cross pathway 1 off. If you came here for a story about Bitcoin technologically imploding, that is not this video, and I would gently suggest that anybody selling you that story has not looked at a hash rate chart in 4 years. Which brings us to pathway 2, and this is where it stops being comfortable. Because something did break this year, it just was not the code. For 15 years, Bitcoin's price came down to whether a very large number of individual humans wanted to buy or sell. Emotional, chaotic, unpredictable, but human. Then the exchange-traded funds arrived, the corporate treasury companies arrived, and the industry sold all of us on one specific promise. Institutional money means stability. Adults in the room. No more panic selling. Here is what actually happened. Research cited across this year's flow coverage estimates that exchange-traded fund flows now explain roughly 45% of Bitcoin's weekly price movement. 45%. Not sentiment. Not adoption. Plumbing does not have conviction. Plumbing has a redemption schedule. In June, those funds posted the worst month in their history. Between $4 and $4.5 billion pulled out, depending which data provider you ask, and I flagged that gap because 2 reputable sources disagree by $400 million and nobody seems bothered. BlackRock's fund alone was about 79% of it. 2026 became the first calendar year since launch where net flows went negative overall. Now hold that thought, because it gets better. Or worse, depends entirely on your position size. Back to Dale, in the horse trailer. Dale does not have opinions about monetary policy. Dale has a power bill. In the first quarter of this year, publicly traded miners like the ones Dale competes against sold more than 32,000 Bitcoin. Single quarter record. It beat everything they sold in all of 2025 combined, and it beat what they dumped during the Terra collapse in 2022. Mining revenue per unit of computing power fell into the high $20 range against a break-even near $35 for older machines. One large operator liquidated its entire treasury, another took its holdings to zero. Dale did not sell because he lost faith. Dale sold because January was cold and the bill was due. Then there is the third seller, and this is the one that rewrote the story. Strategy, the company formerly called MicroStrategy, built an entire corporate identity on 4 words: we do not sell. On June 29th, they authorized the sale of up to $1.25 billion of Bitcoin, roughly 20,000 coins to cover cash reserves and preferred dividends. The stock is down about 80% from its high. They still hold around 844,000 coins, which is roughly 4% of every Bitcoin that will ever exist. The reason is a number called MNAV, which sounds like a boy band and means the market has decided your company is worth less than the pile of stuff sitting inside your company. Here is the loop, as plainly as I can put it. Price falls, so the premium that funded the buying disappears. No premium, no stock issuance. So you sell coins to pay the dividends. Selling coins pushes the price down, which makes the premium worse. That is not a conspiracy, that is a spreadsheet. So line all 3 up. The funds, the miners, the treasury companies, Bitcoin's 3 largest structural holders all became net sellers inside the same 6 months, and not one of them did it because they changed their mind about Bitcoin. Redemption mechanics. Electricity, preferred stock dividends. Institutional adoption did not remove the panic seller from this market. It replaced him with something that sells on a schedule and does not read the comments. Okay, deep breath. The other side gets the floor now, because if I only ran the bear case, I would be doing the exact thing I just accused everybody else of doing. Somebody built a website whose entire function is counting how many times public figures have been wrong about one specific thing. It is not satire. It is actively maintained, it has sources, timestamps, and a search function. As of this month, it holds 475 Bitcoin obituaries. The first was published in October of 2010 when Bitcoin was worth 11 cents. Peter Schiff is personally responsible for 22 of them, and somebody ran the numbers, which I find genuinely delightful. If you had put $100 in every time somebody announced Bitcoin was dead, you would have invested $47,100 and would own about 1,043 Bitcoin. At today's price, roughly $67 million. So that is the single most effective investment strategy ever devised, and it consists entirely of ignoring economists. The bull case is not only historical either. Long-term holder supply hit a record this year, about 14.8 million coins in wallets that have not moved in over 5 months. Somewhere between 2.3 and 5 million coins are permanently lost, and Fidelity Research found that roughly 566 coins a day are aging into the category analysts call ancient, meaning untouched for a decade, while daily new issuance is only about 450. Read that again. Coins are disappearing faster than they are being created. Great, case closed. Buy the dip, see you at 100,000. Except, here's the problem with the 475 obituaries, and I say this as somebody who genuinely enjoys them. That is not evidence. That is a base rate. A base rate tells you what usually happens, and it usually comes back is the exact reasoning that has talked people into averaging down on every single asset that never did. Every stock that eventually went to zero had a stretch of years where the people calling it doomed were wrong. Being wrong for a long time is what being early looks like from the outside. It is also what being wrong looks like from the outside, and you cannot tell them apart in real time. That is not a flaw in your analysis, that is just the situation. Which brings us back to that parking lot. On June 25th, the amount of Bitcoin held below its purchase price hit 10.83 million coins, all-time record. More than half of every coin in circulation underwater at the same moment. Among recent buyers, it is worse, over 95% of short-term holders sitting at a loss. Lindsay is in that group. She bought in the cluster between $107,000 and $118,000, which was the densest accumulation zone of the entire run. At the midpoint, she is down 43%, and she needs a 76% gain just to get back to even, not to profit, to be exactly where she started. And nobody knows how many Lindsays there are because the industry cannot agree on how many Americans own this stuff. The Federal Reserve surveyed nearly 13,000 adults and found 10%. A Motley Fool survey of 2,000 found 22. A third put it at 30% or 70 million people. That is a threefold spread on the most basic question in the sector, and I would take the Fed number, because 13,000 randomly selected adults beats 2,000 volunteers every time. What we do know is position size, and it is not what the internet implies. The most common crypto holding in America falls between $100 and $1,000. The second most common falls between 1,000 and 5,000. The average gets dragged upward by a very small number of enormous wallets. The typical holding is a few $1,000s that somebody could not really afford to lose and put in anyway. Because the alternative was watching everyone else get rich. That is the actual demographic here. Not whales, not institutions. People holding a number too small to change their life and too large to shrug off. By the way, if breaking things down like this is useful to you, I run a school community where I go through this kind of thinking in more depth. Link is below. Now, that open loop from the beginning. Let me close it, because it is the actual thesis of this video. Peter Schiff, in June, with Bitcoin sitting around $65,000, said this: "For all practical purposes, for most investors, it will feel like zero. Bitcoin will lose over 99% of its market value, even if it still trades above zero. The most committed Bitcoin bear alive handed a clean opportunity to predict zero, declined, he predicted 99%, and he predicted survival. Even the bears are not arguing for zero, they are arguing for something functionally worse and rhetorically weaker. an asset that lives forever and never pays you back. That is the reframe I have been building toward this whole time. Zero is not the risk. Zero was never the risk. The risk is a thing that survives indefinitely, gets covered respectfully, maintains a network, and simply does not return your capital inside your investing lifetime. There is a real structural argument underneath that, and it is the one nobody puts on a thumbnail, because it needs 90 seconds and a picture. So here's the picture. Dale is a bouncer. He gets paid two ways: a guaranteed salary from the club and tips from the people coming through the door. Right now, the tips are 0.6% of what he takes home. The salary is everything. And every 4 years, the club cuts his salary in half. Not because he did anything wrong. It is written into the contract, it is public, and everybody has known since day one. Meanwhile, the club keeps getting bigger, and the people trying to get inside keep getting richer. Run that out on the screen there. By 2036, his salary is down to roughly an eighth of today's. So one of three things has to be true. The value of what he is paid in goes up about eightfold, or the tips grow by a factor of well over 100 and start doing the job the salary used to do, or the guy guarding more than $1 trillion works for a fraction of what he makes now. Nobody has a satisfying answer to that. Not the bulls, not the bears. It is the only argument in this entire video that does not depend on anybody's mood, and it does not resolve for another decade. Which is precisely why it never makes a thumbnail. There is one more, and it got dramatically more real this year. In February, a proposal called BIP 360 was merged into Bitcoin's official code, introducing the first quantum-resistant address type. 2 months later, a companion proposal laid out something considerably more dramatic: a plan to migrate and potentially permanently freeze somewhere between 6.5 and 7 million coins sitting in addresses that a future quantum computer could crack. Roughly a third of all supply, including an estimated 1.7 million coins widely believed to belong to Satoshi Nakamoto himself. The proposal's own text states that as of March 1st, over 34% of all Bitcoin has revealed a public key on the blockchain. Google researchers this year cut the estimated resources needed to break those signatures by about 20-fold. Serious people disagree wildly on timing. Some say 5 to 7 years, and Adam Back, who has been building this stuff since the 90s, says 20 to 40. But sit with the shape of it for a second. In order to protect the money that cannot be confiscated, they may have to confiscate a third of it. That is the most Bitcoin problem that has ever existed, and there is no version of solving it that does not cost something real. So, is Bitcoin going to zero? Almost certainly not, and I want to be completely direct about that. The network works. The computing power is at records. The lost coins are real. The 475 obituaries are funny and they are instructive. But that answer is a trap, and both sides benefit from it, which is why you never get offered anything else. The bulls love the zero question because it is easy to win. The bears love it because it makes them sound brave. And while everybody argues about the extreme, nobody makes you answer the three questions that actually decide what happens to your money. 1. Who is the buyer after you, and what do they have to believe? 2. What has to be true, specifically and numerically, for this to work over your holding period, not over the internet's? 3. What does not going to zero actually get you if it takes 15 years to break even? Lindsay went looking for an answer to the zero question and did not find one worth having. What she found instead was that she had never once written down what would need to happen for her $4,200 to become $8,000. Not hoped. Written down. And when she did, the honest version needed the price to roughly double inside 6 years. Entirely possible. And something she could not defend for 60 seconds against anybody who pushed back. So she did not sell, and she did not buy more. She wrote the number down and gave herself a date to check it. That is not a triumphant ending. It is just the first time in 9 months she was making a decision instead of absorbing one. Dale is still in the trailer. His math gets measurably harder every 4 years, whether anybody's opinion changes or not, which is something he understood long before most of the people writing about this did. And Hollis, from earlier, the $500, the coworker at lunch, he forgot the password. He is part of the 4 million lost coins holding up the entire scarcity argument. He has been contributing to the bull case for 12 years completely by accident and has personally received nothing. I think about him a lot because that is a suspiciously good description of how a lot of people experience this asset. I am not a financial advisor, and this is not financial advice. It is arithmetic and a long look at some very public documents. Here is what I would leave you with. You are allowed to look at all of this, decide you cannot honestly answer those 3 questions, and simply not have a position. Sitting out is a position. It has a return, it has a risk profile, and it does not require you to be right about quantum computing. And if you can answer all 3 out loud without flinching. To somebody who actively disagrees with you, then you do not need a video to tell you what to do. That is the whole test. Everything else is just somebody's story about why the next buyer is going to show up.